It was March 2020. Markets dropped 30% in 3 weeks. Your retirement account looked like a crime scene. Most people panicked. A few did not. Those few had something different inside their portfolios. Not luck, not insider knowledge. A specific structure built to survive exactly what everyone else called unthinkable. I spent months researching this pattern, pulling crash data from 2000, 2008, 2011, 2015, 2018, and 2020. I needed to figure out what actually held when everything else collapsed around it. What I observed was not random. 6 specific ETFs appeared again and again across every major downturn. Not because they were popular, because they were structurally different from everything else. Before we go further, have you ever held an ETF through a crash and watched it survive, or did yours fall with everything else? Tell me in the comments below. If you are serious about building a portfolio that lasts longer than a single bull market, subscribe now. This channel does not sell hope, it delivers structure. Hit subscribe. Now let us get into why most portfolios fail during crashes and why these 6 ETFs consistently did not. The answer starts with how crashes actually work beneath the surface. Every major crash since 2000 had a trigger: dot-com collapse, housing fraud, pandemic shock. But the deeper pattern was always the same. Investors fled growth and rushed towards safety. When fear takes over, money does not disappear, it moves. It rotates into specific asset classes that have historically absorbed panic, rather than amplified it across the market. The investors who protected their wealth understood this rotation. They were already positioned inside the assets that receive panicked capital. That positioning is exactly what these 6 ETFs represent. The first ETF is IEF, the iShares 7 to 10-year Treasury Bond ETF. During every significant crash, government bonds received massive inflows. IEF gained nearly 8% during the 2020 crash alone. This happens because institutional investors treat U.S. Treasuries as the global safe haven. When equity markets collapse, trillion-dollar funds rotate into bonds automatically. IEF sits directly inside that rotation path. The second ETF is GLD, the SPDR Gold Shares ETF. Gold does not always spike during crashes, but it consistently holds value when currencies and equities lose credibility simultaneously across global markets. During the 2008 financial crisis, GLD finished the year positive, while the S&P 500 lost nearly 40%. That gap in performance is not coincidence. It reflects gold's structural role in fear-driven markets. The third ETF is VPU, the Vanguard Utilities ETF. Utilities are boring by design. People pay electricity bills regardless of market conditions. That predictable cash flow makes utilities resilient when discretionary spending collapses. During the 2001 recession and the 2008 crash, utilities significantly outperformed the broader market. VPU captures that defensive characteristic with low fees and deep diversification across the entire U.S. utility sector. The fourth ETF is XLP, the Consumer Staples Select Sector SPDR Fund. People still buy food, medicine, and household products during recessions. The companies inside XLP sell exactly those non-negotiable categories of human spending. Procter & Gamble, Costco, Coca-Cola, and Walmart anchor this ETF. These are businesses with pricing power and stable demand even when consumer confidence collapses and unemployment rises sharply during economic contractions. During the 2008 crash, XLP fell significantly less than the S&P 500. During the 2020 crash, it recovered faster. That pattern repeated because the underlying business model is fundamentally resistant to demand destruction. The fifth ETF is USMV, the iShares MSCI USA Minimum Volatility Factor ETF. This ETF does not chase high-growth stocks. It systematically selects companies with the lowest historical volatility inside the U.S. equity universe. The construction methodology filters out the most aggressive risk exposures while maintaining equity market participation. During drawdowns, USMV historically loses less than the S&P 500 and recovers with considerably less psychological damage to investors. This matters more than most people acknowledge. A portfolio that drops 20% needs 25% to recover. A portfolio that drops 10% only needs 11%. The math compounds powerfully over time. The sixth ETF is SCHD, the Schwab U.S. Dividend Equity ETF. Dividend-paying companies with strong fundamentals tend to be mature, cash-generative businesses. Those businesses do not evaporate when markets panic across the broader economy. SCHD selects companies with consistent dividend growth, strong free cash flow, and solid return on equity. That filter automatically excludes speculative, over-leveraged companies that collapse first whenever credit conditions tighten during a serious downturn. During every significant market stress since SCHD launched in 2011, it has outperformed the broad market on a risk-adjusted basis. The dividend income also provides psychological and financial stability when price appreciation disappears entirely.
Now, understanding what these 6 ETFs are is only half the equation. The more important question is why most investors still do not hold them, even after experiencing devastating losses. The answer is behavioral. During bull markets, defensive ETFs feel like a penalty. They lag behind high-growth technology stocks. They feel slow, boring, and unnecessary when everything around them is rising aggressively. This is exactly the trap. Investors abandon defensive positions during good times because the opportunity cost feels real. Then, when crashes arrive, they have nothing left to absorb the damage structurally. I observed this pattern repeatedly across the data. Retail investors consistently overweight growth during expansion and desperately search for safety only after the collapse has already destroyed a significant portion of their capital. Professional portfolio managers do the opposite. They maintain defensive allocations permanently, not because they predict crashes, because they accept that crashes are inevitable and position accordingly before the damage ever begins. This is the core discipline separating wealth preservation from wealth destruction. It is not intelligence. It is not access. It is the willingness to hold something boring when boring feels wrong to hold. The allocation question matters significantly here. Holding all 6 ETFs equally is not necessarily the right approach. The correct weighting depends on your age, income stability, and proximity to retirement or major financial goals. A 40-year-old with stable employment can afford more equity exposure through SCHD and USMV while maintaining smaller allocations to bonds and gold. The defensive layer acts as ballast, not the entire portfolio structure. A 55-year-old approaching retirement requires a meaningfully different balance. The cost of a major drawdown at that stage is not just financial, it directly threatens the timeline and security of retirement itself. IEF and GLD become more significant as you approach capital preservation mode. The goal shifts from accumulation to protection. These 2 ETFs specifically address that shift with structural precision and historical consistency. There is also the rebalancing discipline to consider seriously. These ETFs will drift out of alignment as markets move. Without periodic rebalancing, your defensive structure gradually erodes and your actual risk exposure creeps higher unnoticed. Annual or semi-annual rebalancing forces you to systematically sell what has grown and buy what has lagged. This is mechanically uncomfortable and psychologically difficult. That difficulty is precisely why most investors never do it consistently. The investors who actually protected wealth across every crash since 2000 were not geniuses. They were disciplined. They built a structure, maintained it through discomfort, and did not abandon it when growth appeared to punish them. One additional consideration that rarely gets discussed is sequence of returns risk. 2 investors with identical average returns can have dramatically different outcomes based purely on when their losses occur relative to withdrawals. If a major crash happens in the first 3 years of your retirement, it can permanently impair your portfolio's ability to recover, even if markets eventually return to previous highs over the following decade. These 6 ETFs directly address sequence risk by reducing drawdown depth during exactly those critical early retirement years. That protection has compounding value that simple return comparisons between ETFs and indexes completely fail to capture. The current market environment makes this conversation particularly relevant. Valuations across U.S. equities remain historically elevated. Interest rates have shifted the cost of capital significantly. Geopolitical uncertainty continues to build pressure beneath market surfaces. None of that means a crash is imminent. Nobody can tell you that honestly. What it does mean is that the case for maintaining defensive allocations is structurally stronger today than during most periods in recent financial history. This is not pessimism. This is probabilistic thinking. The question a serious investor asks is not whether the market will fall. The question is whether your portfolio is structured to survive it when it does. These 6 ETFs answer that question. Not perfectly, not without any drawdowns, but with a proven pattern of absorbing shock better than undefended equity portfolios across 6 major market stress events spanning 25 years of data. Build the structure now, maintain it through the discomfort of bull markets, rebalance it with discipline, and when the next crash arrives, your portfolio will behave fundamentally different from the ones built purely on optimism and momentum. If this analysis gave you something concrete to act on, press the like button right now. Not for me, because the algorithm will show this to another serious investor who genuinely needs this exact framework today. Drop a comment telling me which of these 6 ETFs you already hold and which one surprised you most. I read every single comment. Your response will shape the next video directly. And if you subscribed earlier in this video, you made a sound decision. If you have not yet, consider this. The next crash will not announce itself. The investors who survive it are already prepared right now. The work does not stop here. Research it further. Verify it against your own situation. Talk to a qualified financial advisor before making allocation decisions, but start the conversation with your portfolio today, not after the damage arrives.